Becoming a millionaire and staying one are two very different challenges. Many people assume that wealthy individuals got rich through a single lucky break, a stock tip, a startup exit, or an inheritance, and that from there, the money simply takes care of itself. In reality, most self-made millionaires follow a set of consistent, often unglamorous investing principles that separate long-term wealth building from short-term speculation. Understanding how millionaires actually allocate and grow their money reveals a mindset that anyone, regardless of income level, can learn from. 1. They prioritize assets over liabilities. The single biggest difference between millionaires and everyone else isn't income, it's where the money goes after it's earned. Millionaires tend to direct a large share of their earnings into income-producing or appreciating assets, stocks, real estate, businesses, and retirement accounts. They generally avoid letting lifestyle inflation consume raises or windfalls. Instead of upgrading their car or house every time their income rises, they funnel the difference into investments that compound over time. This doesn't mean millionaires never spend on comfort or luxury, many do. But the spending typically comes after a foundation of assets has already been built, not instead of it. The order of operations matters. Invest first, then spend what's left, rather than spend first and invest whatever happens to remain. 2. Diversification across multiple asset classes. Very few wealthy individuals keep all their money in one type of investment. A diversified portfolio might include public equities, stocks and index funds, often the single largest component of a millionaire's portfolio. Real estate, both a primary residence and income-producing rental or commercial property. Private business ownership, equity in their own company or investments in other private businesses. Fixed income, bonds and bond funds for stability and income. Cash and cash equivalents, money market funds or short-term instruments for liquidity and opportunity. Alternative investments, private equity, venture capital, or in some cases collectibles and commodities. Surveys of high-net-worth individuals consistently show that equities and real estate make up the bulk of most portfolios, with business ownership playing an outsized role for those who built their wealth through entrepreneurship rather than salary alone. The exact mix shifts with age, risk tolerance, and how the wealth was originally created, but the underlying principle is the same. Don't rely on a single asset class to carry the entire portfolio. 3. A long-term, patient mindset. One of the most consistent traits among wealthy investors is patience. Rather than chasing short-term market movements or trying to time trades perfectly, many millionaires hold investments for years or decades, allowing compound growth to do the heavy lifting. This buy and hold approach reduces transaction costs, minimizes tax drag from frequent trading, and avoids the common trap of buying high out of excitement and selling low out of fear. This patience also extends to how they view market downturns. Rather than panicking during a correction, many wealthy investors see volatility as a normal part of investing, and sometimes as an opportunity to buy quality assets at a discount. This emotional discipline, more than any specific stock pick, is often what separates those who build lasting wealth from those who don't. 4. Real estate as a core holding. Real estate remains one of the most common vehicles for building and preserving wealth among millionaires. It offers several advantages that appeal to long-term investors. Leverage, the ability to control a large asset with a relatively small down payment. Income, rental properties can generate steady cash flow. Appreciation, property values have historically trended upward over long periods, though not without regional and cyclical variation. Tax benefits, depreciation, mortgage interest deductions, and other incentives in many tax systems favor property owners. Many millionaires own their primary residence outright or with a modest mortgage, alongside one or more investment properties. Others invest in real estate indirectly through real estate investment trusts, REITs, which offer real estate exposure without the responsibilities of being a landlord. 5. Business ownership and equity stakes. A large share of self-made millionaires built their wealth not from a paycheck, but from owning equity in a business, either one they founded or one they hold shares in through stock compensation, private investment, or partnership. Business ownership carries more risk than a diversified index fund, but it also offers the potential for outsized returns, since the owner captures the full value created by the enterprise rather than a fixed salary. Even after selling a business or stepping back from day-to-day operations, many wealthy individuals continue investing in private companies, either as angel investors or through venture capital and private equity funds. This keeps them connected to the kind of concentrated, high-growth bets that built their initial fortune, while balancing that risk with more conservative holdings elsewhere in their portfolio. 6. Tax-efficient investing. Wealthy investors are often highly attentive to the tax consequences of their investment decisions, not out of an intent to avoid taxes improperly, but because tax efficiency compounds just like returns do. Common strategies include maximizing contributions to tax-advantaged retirement accounts, holding investments long enough to qualify for lower long-term capital gains rates, using tax loss harvesting to offset gains, structuring charitable giving in ways that provide tax benefits while supporting causes they care about, working with financial advisors, accountants, and estate planners to structure their affairs efficiently. This attention to tax strategy is one of the less visible but more impactful habits of wealthy investors, since taxes are one of the largest recurring costs an investor faces over a lifetime. 7. Professional guidance and continuous learning. Contrary to the image of the lone genius investor, many millionaires rely on a team, financial advisors, accountants, attorneys, and sometimes family offices, to manage the complexity that comes with significant assets. At the same time, they typically stay personally engaged with their finances rather than handing over full control. They read financial statements, understand the basics of the markets and asset classes they invest in, and ask informed questions of their advisors. This combination of professional support and personal financial literacy allows them to make informed decisions rather than blindly following advice, while still benefiting from specialized expertise in areas like tax law, estate planning, and complex investment structures. 8. Maintaining liquidity and managing risk. Despite having significant net worth, most millionaires keep a portion of their assets liquid, easily accessible cash or cash equivalent holdings. This serves two purposes. It provides a cushion against emergencies or economic downturns, and it gives them dry powder to take advantage of investment opportunities when they arise, such as buying assets during a market dip. Risk management also extends to insurance. Many wealthy individuals carry adequate life, liability, disability, and property insurance to protect their accumulated assets from being wiped out by a single unexpected event. What this means for everyday investors. The strategies described above aren't exclusive to people who already have seven-figure net worths. The underlying principles, prioritizing investing over consumption, diversifying across asset classes, maintaining a long-term perspective, seeking tax efficiency, and managing risk, are accessible at any income level. Someone investing $200 a month into a diversified index fund is applying the same fundamental logic as a millionaire allocating a much larger sum across stocks, real estate, and business interests. The scale is different, but the discipline is the same: consistent investing, patience through market cycles, diversification instead of concentration in a single bet, and attention to the quiet compounding effects of time, taxes, and fees. Wealth building, in this sense, is less about a single dramatic decision and more about a set of habits sustained over many years, which is exactly why it tends to look unremarkable from the outside, even as it produces remarkable results over time.